Hello everyone, welcome back to another weekly outlook for EU. As always, I'm going to break everything down step by step in a mechanical and structured way so you can get a clear idea of what price might do this week. So let's get started. First thing first, let's look at the monthly time frame. Now last week, price was sitting right around this level, and if you remember from the last breakdown, I outlined a bullish expectation for price. And look what happened. Price expanded higher and formed a clean bullish move just like we anticipated. Now the big question is what's next? What is price likely to do this week? And again, just like I always say, the goal here isn't to predict the price action for next week or next month, but only this week, right? For this particular outlook, we are focused on the price action for this week and this week only. That's it. So let's look at the charts and let's figure out what price might do this week. Right now, price is inside the premium region of this whole dealing range, right? And within this dealing range, the premium region of this dealing range, we've got two key levels. First of all, we've got this monthly fair value gap right here, right? And then along with that, we have also got this monthly order block, right? And my drawn liquidity remains higher, right? Specifically targeting this monthly fair value gap and this monthly order block, right? And also along with that, we've also got CPI news this week, right? Which could be a catalyst for this movement. So my expectation for price is that price will likely continue this bullish move higher into this fair value gap and potentially towards this order block, and then from there we might see a retracement before we could potentially move higher again, right? So to sum it up for the monthly time frame, my directional bias remains bullish and my target for price this week is first of all this monthly fair value gap along with this monthly order block, right? This is what I see on the monthly time frame. I'm going to go down to the weekly time frame and I'm going to refine these key levels even more, and then I'm going to outline different potential scenarios that we can have based on the lower time frame price action, right? Now from this price action, it might seem a bit too obvious that obviously we're going to reach this key level in this order block, but when I break down the price action on the daily and the 4 hour time frame, then you'll get a clearly defined idea of the different potential and possible scenarios that price have that it can play out. And you'll also get to find out about the different details and intricacies about this market context and this narrative that we've got. So let's go down to the weekly time frame and let's analyze the price action. Now looking at the weekly time frame, the overall narrative remains the same. Within this dealing range that we've got two premium key levels. We've got this significant swing high, this weekly swing high, and along with that, we've also got this weekly fair value gap, right? So my target for price this week is first this swing high and then eventually this weekly fair value gap, right? Now, here's where things gets interesting. We also have CPI on Wednesday, right? Which means that we can have a potential manipulation move on that particular day. Red folder news event or a red folder day equates to or correlates to a manipulation day, which then also means that we've got three high probability scenarios for how price might move this week. The first scenario is that on Tuesday, price doesn't take out this high and instead it stays below it. And then on Wednesday, we get a manipulation move higher. We get a manipulation move higher on Wednesday, in which we take out this swing high and we reach this weekly fair value gap. And then on Thursday and Friday, we retrace lower and close the week lower. This is the first scenario that we can have. Tuesday's price action stays below this high. Then on Wednesday, we manipulate higher to reach the drawn liquidity. And then on Thursday and Friday, we retrace lower and close the week lower. The second scenario that we can have is that on Tuesday, price continues this bullish move higher, right? And it takes out this swing high. It takes out this swing high and reaches the fair value gap. And then on Wednesday, we see a manipulation move lower and it leads to a retracement after this whole extended bullish move, right? This is the second scenario that we can have or that price can play out. The third scenario is that on Tuesday, we reach the drawn liquidity here and then we retrace back during the New Year kill zone. And then on Wednesday, we have a manipulation move higher and we test this weekly fair value gap. And then on Thursday and Friday, we retrace back and close the week lower. These are the three different high probability scenarios that price can play out. And then based on these scenarios, you can potentially decide whether which way you want to trade, right? And then you can refine your decision making process and your thought process based on these three different outlines and potential scenarios. But either way, my directional bias remains bullish, right? And the drawn liquidity remains, first of all, this high and then eventually this weekly fair value gap, right? And until and unless price reaches these key levels in these drawn liquidities, I won't be looking for any short trades. Now let's go down to the daily time frame and let's dig a little bit deeper. Now looking at the daily time frame price action, we've got the same narrative and market context, right? And I know some of you might be thinking that this is getting repetitive and boring. But listen, this is exactly what real and professional trading looks like, right? It's about following the same mechanical approach every single day, nothing fancy, no overcomplication, and just sticking to a system and executing it over and over again, right? That's what discipline is. And honestly, after doing this for so long, you kind of get desensitized to the excitement, right? You start trading based on what needs to be done, right? You don't trade based on how you feel, but you trade based on what's need to be done, right? And I know that in these outlooks and in these breakdowns, I'm kind of repeating the same things to you, right? I'm looking at the dealing ranges, identifying the correct key levels within those dealing ranges, and then I'm determining the directional bias for you, right? It's all the same stuff over and over again. But let me tell you, this is exactly what real trading looks like, right? I know that a lot of traders struggles with the fact that trading can feel boring and repetitive, just like these outlooks, and I get it, right? When you are first starting out, trading feels exciting, right? You're analyzing the markets, you're watching price move in real time, taking trades and feeling that rush. But as you become more experienced, you realize that real trading isn't about excitement, it's about discipline, right? Look at the best traders in the world. They're not waking up every day trying to reinvent the wheel, right? They're not chasing new strategies or looking for the next holy grail. They show up every single day and do the same thing over and over again. The same analysis, same mechanical approach, same execution, and same entry models, just like me, just like these outlooks, just like these trade breakdowns that I'm explaining to you, right? And yeah, I know that that might sound boring, but guess what? That's exactly what makes them profitable and what makes me and what will make you profitable, right? Think about a professional athlete, a boxer, for example. Do you think they spend every day learning new punches, right? Do you think that? No. They drill the same jabs, the same footwork, the same combinations, the same hooks, the same uppercuts thousands of times, right? And they don't do it because it's fun. They don't do it because it's exciting, but they do it because that's what makes them sharp, and that's what makes them consistent, and that's what makes them successful, right? And trading is no different. Every day I come into the market and I apply the same mechanical approach, I apply the same rules, I follow the same plan, and I execute the same way based on the same set of rules. And I know it gets repetitive, it gets boring, but that's what consistency looks like. Most traders fail because they can't handle the boredom. And that's exactly how they get caught in the cycle of inconsistency, where they jump from one thing to the next and never stick to a plan long enough so that they can see the results of it. Right? And listen, if you are serious about trading, you need to accept that it's not supposed to be exciting, right? If your trading feels exciting all the time, then you're probably gambling and not trading. You need to embrace the routine, embrace the repetition, embrace the boredom, because that's what builds real skill. If you're always seeking dopamine, if you're always seeking excitement and happiness and prosperity, then you will never get anywhere, right? And I always say this: discipline isn't about motivation, right? It's about showing up and executing even when you don't feel like it. Because at the end of the day, it doesn't matter if you are in the mood to trade or not. It doesn't matter if you feel like analyzing the charts or not. The market does not care about your feelings, right? You either follow your plan or you don't. You either trade with discipline or you don't. So if you ever find yourself thinking that, man, this is getting boring, then good. That means that you're finally trading like a professional, because professionals don't trade for excitement. They trade for one thing, and that one thing is to make money, right? Not to seek dopamine in trading, not to seek excitement, but to make money, right? You're only here for one purpose, that is to make money. And to make money, you have to embrace this boring and repetitive routine, right? And also to learn properly from me, to learn from anyone, right? Not just me, from any other mentor. You'll have to go through the same repetitive videos. Now, if you find a mentor or someone that makes exciting videos where they rain you down with different things every single video, then that probably means that they're not consistent in their teaching. They're not showing you the right things, or maybe they don't know what they're doing themselves, right? But if you see someone like me or Romeo and you see that they are repeating the same thing over and over again, that means that they actually have a system. They actually have something that they follow every single day, and they're not like showing you in uh, giving you different holy grails and different videos. That's why our videos feel like boring and repetitive, right? Because we know what professionalism looks like. So if you're in this game for the long game, right, then stop chasing the thrill and start chasing consistency, right? Now let's get back to the charts. Now back to the daily time frame. Right now, price is just about to take out this high, right? This is the same high from the monthly candle range, the monthly candle range high, and above that we've got the monthly fair value gap and also this weekly fair value gap. Now, just like I said earlier, we've got three possible scenarios for this week. The most likely scenario for price is that price continues this bullish move on Tuesday and takes out this swing high and then retraces during the New York kill zone, right? And then on Wednesday, we see a manipulation move towards the weekly FEG higher before we retrace and we form a retracement profile on Thursday and Friday, right? The most likely scenario is that price takes out this high today, retraces during the New York kill zone, then on Wednesday we manipulate higher and reach this weekly fair value gap, and then we retrace from there and close the week lower. The alternative scenario is that price does not take out this high on Tuesday, but instead it ranges around here and stays below this high. And then on Wednesday during CPI, we see a liquidity graph, price takes out this high, and then it reverses from there. Or another scenario would be that price takes out this high on Tuesday, and then Wednesday has a manipulation leg lower below these lows, right here, and then we continue moving higher towards the weekly FEG on Thursday and Friday. But that's the least likely scenario in my opinion, right? But either way, my main objective remains the same: take out this high and reach the weekly refined fair value gap, which is this fair value gap of this FVG right here. But for now, as I said before, I'm only looking for longs and I won't consider shorts unless I have a very strong reason to do so, right? Now, you might be wondering what happens after price reaches this down liquidity, right? Once price reaches these levels, I expect a retracement on the higher time frame, most likely on Thursday and Friday, right? Because we from all of this bullish price action we've had, I don't know, 1, 2, 3, 4, 5, 6, 7. We've had 7 days of consecutive bullish price action, and I don't think it will continue. Like it can continue this bullish price action, but not on Thursday and Friday. I expect a retracement before we could continue moving higher, right? And I expect that based on market profiles. But of course, before executing any short trades, I'll need a strong confirmation, right? I won't just execute a short trade straight away. I would need some strong. I would need a strong reason to do so. Simple. Now let's go down to the 4-hour time frame and let's break things down even further. So yesterday on Monday, I was expecting a case of death phase, right? Meaning I was looking for price on Monday to move lower and take out this 4-hour low and reach this fair value gap before continuing higher towards the down liquidity. But what happened? What happened is that, well, we got the bearish price action, but before we could take out this high, not this high, before we could take out this 4-hour low, we had an SMT divergence with GU. Right here, you can see that GU took out its short-term low and tested this corresponding FVG, but EU failed to test that corresponding FVG and failed to take out this low, and it led to an SMT divergence. And this SMT divergence confirmed the case of death phase, right? Because we got this case of death phase on GU already, so there's no reason for me to expect another one on EU because we already have one, and that's what we consider, or that's what we refer to as divergences, right? So we have a divergence, and that divergence confirmed the case of death phase, and now the expectation for price is to continue moving higher towards the down liquidity without any counter turtle soup, right? Because we've already had one on GU. That's what my expectation for price are. Now let's talk about entry opportunities. Now today, obviously, as I said, the down liquidity is higher, so you could have taken a solid entry right here after price took out this candle range low, and tested this order block. You could have taken an entry right here at the London Opal Kill Zone today, and that would have been a high probability trade. Now, another trading opportunity would be in the form of if price does not reach this drawn liquidity by the New Year session open, then during New York open, you could look for a continuation trade on the lower time frame, like the 1 hour or even the 4 hour, like on this time frame, and then look for a continuation trade higher. Maybe we close this 5 a.m. candle somewhere around here and we form a new FVG. Then we will take this 5 a.m. candle as a candle range and look for long entries once it gets purged, right? But we will only do that if price doesn't reach this down liquidity by New York open. But if it doesn't indeed reaches it, then maybe I'll wait for this 5 a.m. candle to close, and then once the 9 a.m. candle opens, I will wait for it to get purged, and I will only and only look for shorts from here, a counter short from here, if we have a strong SMT divergence with either GU or DXY, right? And we have a clear confirmation signal. But if we don't have any strong SMT divergence, then I won't be executing any short trades, right? Because as I said before, I need a strong reason to do so. And obviously my risk on that particular trade would be half of what I usually risk on trades that are aligned with the drawn liquidity, right? So to wrap things up, the directional bias remains bullish. The target, the targets are first of all this high and eventually the weekly fair value gap. The different possible scenarios are, I already explained them to you, right? We can have three possible scenarios. And my main expectation are bullish Tuesday, then manipulation Wednesday, and then bearish Thursday and Friday, right? Now I'll be waiting for price to do what it needs to do, right? I don't know if I said that right, right? I'll just be waiting for price to form and do whatever it got to do, and then I'll post a daily outlook on Thursday to update you guys on what might happen next on Thursday and Friday, right? I won't be trading on Wednesday because I don't trade on red field and news event days, right? Like NFP, FOMC, and CPI. But on Thursday, I'll make sure to upload a weekly out, not a weekly, a daily outlook, and I'll analyze what happened on Wednesday, and then I'll show you what are the different scenarios or the different trade outlines that we can have based on that price action, whether we can form a bearish price action and retrace lower, or we can continue this move higher. I'll update you on that. But for now, these are the different entry opportunities that you can look for. Right? This is the weekly outlook.